In this video, we're going to be looking at part of effective financial management. We're going to be reminding ourselves of revenue, costs and profit, cash flow and break even. I'm going to do a separate video for the long-term finance and short-term finance. Otherwise, this video, I think, will go on too long and I might just lose you along the way. First of all, let's remind ourselves about cash flow. Now, cash flows into a business are things like revenue and interest from savings on a business bank account, for example. Cash flows out of a business are all the bills that a business has to pay, like salaries or rent. And net cash flow is the difference between the cash coming in and the cash going out of a business. Ideally, you want to have a positive net cash flow every month. Now, don't forget, profit and cash flow are two very different things. Cash flow is simply about money coming in and going out from a business. Now, the challenge for a manager is to make sure there's always enough cash to pay expenses when they are due, as running out of cash threatens the survival of a business. If a business runs out of cash and cannot pay its suppliers or workers, it is what we call insolvent. The owners must raise extra finance or cease trading. And this is why planning ahead and drawing up a cash flow forecast is so important, as it identifies when a firm might need to arrange an overdraft. So why is cash so important? Well, a business can still be profitable. It can still earn profit. However, it's all about the timing. If it runs out of cash, it hasn't got enough cash in the account to pay its bills, then it will cease trading. And the idea is to speed up all the inflows coming into the business. You want the cash in as quickly as possible, and you want to slow down the cash going out as long as possible. Now, improving profit. Well, there are techniques that you can use or a business can use. However, there may be negatives for that. For example, a business might find that it's able to cut the costs of its materials. However, it has to be careful that the quality of the materials that they're using is not compromised. A business may choose to actually cut labour costs. However, that can lower motivation of the workforce. A business might decide to cut back on investment and not spend money on growth and developing a business. However, that can damage a long-term competitiveness. It could be that business thinks, well, we can improve profit if we have better products. However, that might be expensive to develop. An obvious one is to increase prices. However, quite often, if you increase a price too high, you might actually lose customers who prefer to switch to competitors' products. So in fact, you put your selling price up high, you might find that your revenue actually falls because you lose customers. I'm going to suggest that you pause this screen and make notes of the following bits at the bottom of the screen. Okay, now we're going to remind ourselves of revenue and costs and profit. Revenue is cash flowing into a business, costs are cash flowing out of a business, and revenue minus costs is your profit, or it might be your loss. So revenue tends to come from customers and businesses. The formula is the selling price times the quantity sold. So for example, £25 per item, 6 items sold, 150 revenue. However, revenue can come from things like bank interest as well. And also, when a business is taking out a loan, the bank, although it's not proper revenue, the bank will give the business a cash lump sum. And that is cash inflow into the business. So it's still money coming into a business. Which of the following is a cash inflow? Pause the video and then I'll reveal the answer. Okay, taking out a loan. Now, payment to suppliers, cash going out of the business. Purchasing assets is cash going out of a business. Longer term credit terms for customers. Well, actually, that is not improving the cash flow. You're allowing your customers to pay you later, so you're delaying that payment. However, taking out a bank loan, a bank will give a cash lump sum to a business, and that's cash coming into the business. So, just to remind ourselves that revenue is cash inflow, costs are cash outflows. And of course, there's two different types of costs. There's fixed costs and variable costs. Fixed costs are costs that must be paid every month, regardless of the number of products made. So, for example, things like rent, advertising, salaries, insurance, they have to be made whether any products are made or not. Now, in the exam, you may very well be given total fixed costs. If not, you might be given a few items that are fixed costs and you'll have to add them up. Variable costs are costs that vary according to however many products are made. So that's things like materials and packaging and postage. You might have to add them up to find out the total variable cost per unit. And your total costs are your fixed costs and variable costs put together. Right, I'm going to show a few questions now. I'm not going to do any talking, so what I suggest is just go through these questions, pause the screen. When you see a question, give it a go before the answer is revealed. Now we're moving on to break even. This is where a business has not made a loss or a profit. It's where revenue equals total costs. To help a business work out its break-even point, first it needs to calculate the contribution per unit. The contribution per unit shows how much each sale contributes towards paying off the fixed costs. Going back to the figures that we had from before. Using this new formula, selling price minus variable cost per unit. That's £10 selling price, £4.50 variable cost per unit, £5.50. Every sale contributes £5.50 towards the fixed costs of £450. Now the break-even formula. That's fixed costs divided by the contribution per unit. This will show how many products need to be sold in order for all costs to be covered. We know the fixed costs are £450. Contribution per unit is £5.50. That's 81.81 products. This means 82 products need to be sold to break even. Always round up. Let's say a business makes 150 products. What is its margin of safety? Margin of safety is the amount of output between the actual level of output and the break-even level of output. In this case, 150 products are being made. We need 82 to break even. 68 products is the margin of safety. Now we're going to look at some break-even charts. The revenue line always goes from the bottom corner up to the top right-hand corner. In this case, 6,000 is the revenue. Now this business here is selling new weather apps for tablets, and they're selling the app for £2 each. They've got fixed costs of 2,000, variable costs of 40p per app, and here's their break-even chart. If you look at the bottom of the break-even chart, you can see how many products or apps are sold. We've got 3,000 in total there. So we know that actually if we're selling 3,000 for £2 each, that's going to be 6,000. That's the revenue. The line down here, the horizontal line, is the fixed costs. That's going to be the same regardless of the number of apps being made. So if it's 500 apps, it's 2,000 products. If it's 3,000 apps, it's still 2,000 fixed costs, Interesting line here, this is your total costs. That's your fixed cost plus your variable put together. Now this is a tricky one. Trying to work out break even. Well, actually, it's not tricky. All you need to do is look at the two top lines. Where do they meet? Where do they cross? Here, looking down, it's 1,250 products. So the total revenue line meets the total costs line. The margin of safety is the difference between the number of products made and how many products need to be made to break even. In this case, 1,750 products. Now, break even has its advantages and disadvantages. It's quick and easy to calculate, and it can allow a business to play around with different selling prices to see, excuse me, to see how many products, excuse me, to see if the break even really changes significantly. It also allows a business to calculate how the break even would change if the costs change. Disadvantages, however, are the break even only works if the products are actually sold. So if no products are sold, then break even is irrelevant. They're not going to break even. They're going to be at a loss. It can only be calculated at one product at a time as well. So businesses with numerous products will need to calculate break even for each product. And also, it doesn't allow for any discounts. So if you're buying, if a business is buying raw materials in, the discount isn't always shown, and the same when they're selling in bulk, it's not always shown. Right, sorry about this rush video, but I've got a feeling my phone's going to die any minute now. I'm going to be doing a separate video for Sources of Finance, but please go and look at all the videos on the YouTube channel and make use of all the past questions and all the revision slides on Google Drive. Thank you very much.